Welcome back, everybody. This is Edwin, the Magic Engineer, and there's been a lot of crazy stuff that's actually going on in the finance world lately. And I figured some of you guys might just kind of want to get some insight, some clarification on what is actually happening and why it's actually such a big issue. So I'm actually going to cover the yield curve, the 210 inversion that happened today. I'm going to try to explain what that is, but I'm also going to try to explain in very clear to understand terms about why it's a problem and kind of where we're at. Now, I actually did a video a while ago, one of my earlier finance videos. In fact, I'll link it right here, where I actually discussed how the U.S. government, how the finances of the U.S. government, how it actually works. And what I want to do right now is kind of retouch on that using a similar diagram, but kind of bring it up to today's numbers to make it clear and then bring that discussion over to the yield curve. So let's get started on that right now. So what I've got here for you, shrink myself down. We are looking at, these are all websites. I'll have these linked below. This Macro Trends website basically has the US stock market, and this is a historical chart that's going all the way back to 1915. So an awful long time. Now you'll notice that you see this big run up right here. This basically was the .com, when the .com bubble brought it up and then you had a crash bringing it back down. And then this was the 2008 bubble when it brought the stock market way up and then it popped. And this is where we're basically at today. Now, this bubble right here was basically a stock bubble. This bubble right here is basically like a stock and a housing bubble. And many people, myself included, think that this next one that we're going to see is actually a stock market, housing, and bond market bubble. And so that's kind of really where a lot of the fear is coming in for what's actually happening. Now, you'll notice how tall this is. This isn't inflation adjusted. If I click this box, now, even when you adjust for inflation, I want you to notice how high the .com bubble, the housing bubble, and this bubble basically all were. The .com bubble, when you inflation adjust, it was about at the same level where the last bubble was. And if anyone's wondering where these bubbles come from, you see how you have all this craziness down here, but it stays within a range. This was mostly without government intervention, printing money and doing crazy things. But then as soon as government starts artificially really driving rates crazy and printing all this money, you get all this craziness because they put all this money into the system and then it eventually finds its way into the stock market. So I just want to first be clear that the stock market is, if you thought, let's go back to non-inflation adjusted. If people thought that this was a bubble and this was 2008, then how would anybody not call this a bubble? Don't call this normal market. That's ridiculous. Yes, it's a bubble. Okay. So now the next thing to be clear on is the federal funds rate. Now, I really like this chart. You'll notice that there's vertical bars here that are darker. Every one of those is an actual U.S. economic recession. And what you're seeing here on this line is what's called the federal funds rate. Now, I touched on this in one of my earlier videos. In fact, where we were at was somewhere right in here, somewhere right there. And what I was basically telling people is they're not going to be able to get the federal funds rate all the way back up to where it was. In fact, where it used to be before was look at this, 5.3%. And I basically said in my last video, they're not even probably going to make it to 3 or barely above 3. Then they're going to have to start dropping rates again. And people thought I was watching a chart. It's not based on charts, you guys. The charts follow reality. And there's a reality that these charts are basically telling. And I'm not going to get into what all those realities are because that's very complicated. But what I was basically telling people is we were likely going to start hitting that recession once we started topping off this interest rate and rolling over. And that's why this chart is so important. What you'll notice here is the federal funds rate comes up, and then there's a recession and it spikes down. Then it comes up, recession, spikes down. Comes up, recession, spikes down. Recession, spikes down. You see this repeating pattern again and again. But also notice there's a trend line that slowly kind of goes down, in a slope, right? Well, actually, the way the camera is, it's like this. It's like that. So there's a slope that basically goes down the whole time, and it can't break across that trend line. And so that's what I was basically saying in my last video. Expect that there's going to be a market crash. And it's probably going to happen when they hit that trend line and then start dropping rates again. that's basically where we are. So it's kind of like I told you so, guys. Anyways, let's continue on. So the federal funds rate, I just want to make this clear because most people don't know. This is the interest rate at which the central bank, the Federal Reserve, loans money to other banks. So like if your local bank needs money, and like say they want to do $1 million in loans, well, they can borrow $100,000 from the Federal Reserve, and then they take that $100,000 and the fractional reserve lending, they can loan out $1 million, which is like 900,000 of bank credit plus 100,000 of actual money they got from the Fed, and they owe the Fed this interest rate, which is, you know, at this point in time right now, it's dropping down and it's 2.12. What is that? You know, the federal funds rate. So that's what a bank will borrow money at from the Fed. And then when they loan money to you, what a bank actually does is they take this federal funds rate, they put like 3% on the top, and that's your mortgage. So you notice through this whole time here, the federal funds rate was basically 0. That's why your home loans are basically 3%, because it was 0 plus 3. And now your home loans for a short time got up to like around 5% because it was like 2 plus 3. And you notice banks have been pulling back. So banks have basically been willing to take less profit than 3% on their loans. So that's what this is. It's the federal funds rate is the rate at which banks borrow from the central bank, right? And all loans are kind of like built off of that. Like, and they don't necessarily have to be, but if you want to make money, they are, right? So now the, what I also want to show you here, let me flip to it. And I have this demonstration here. This is basically, I love this little chart. This is a typical US family, right? What you've got over here is you've got your job. You say you're making $33,000 a year. You are the family here in the middle. Say you owe $41,000 a year in bills. That's like your mortgage and your insurance and all those things added together. And you notice that your job isn't enough to cover your bills, and therefore you need to borrow money every single year. So you borrow on your credit card, right? Good plan, right, guys? So your credit card, you're borrowing $7,800 every single year because you don't make enough money in your job. So then after many years of doing this, you owe $219,000 on your credit card. But every single year, you're adding more and more to it. Now, would you agree that there's a problem? Yeah, guys, there's a problem. Anyone who understands even just basic finance inside of your own home would look at something like this and say, yes, there's a problem, right? Well, guess what, guys? Now, if we want to convert this over, we can turn this into the federal budget, basically, by taking every one of these little numbers and you multiply it by 100 million, and then it turns into the federal budget, right? So let's do that right now. Let's perform some magic. So here we are, same numbers. Watch the numbers, guys. Watch the numbers. Bring, there we go. We multiplied all of them by 100 million. So now what was here in your job was 3.3 trillion. Your bills were 4.1 trillion. So you still have the same problem, right? Because it's all relative. You multiplied it by the same number. You now owe 21.9 trillion, and you're putting 0.78 trillion every single year, or 780 billion on your credit card, right? Well, guess what, guys? That is the 2019 federal budget. Oh, sorry, this is the 2018, start of 2019. So what you're basically looking at, these are real numbers, guys. These are the numbers of the actual federal government. Now, you just saw it in a normal household, but with numbers that made sense that you could understand, right? And you knew how big of a problem that $219,000 of personal debt was, right? Well, when you look at it like this, the numbers are bigger, so we get confused, but it's the same problem. You owe a ton of money, and you're not making enough money here. The IRS, you're not collecting enough money through the IRS to cover all the bills of the federal government, and therefore they need to actually sell treasury bonds, which is basically a loan to the government, and the national debt is almost $22 trillion, right? That's the situation, right? So now what actually happens if you run into a problem, right? Well, what if the economy goes down and you can't actually collect enough actual income through the IRS because nobody's making money? And now let's say nobody's also buying bonds. So you have this big problem, right? That's what we were hitting at the beginning of 2008, right? You know, since the economy was crashing, IRS income was down because businesses weren't making money and nobody had money to run out and buy bonds. So there was a problem, right? So what do? This is what you do. Here comes the central bank, and not only, they already dropped rates, right? So they drop those rates down again, but then they do crazy money printing. And yeah, I did the graphic there because it's crazy, right? Money printing is crazy. And you all need to understand that you can't just print money out of nowhere. And if you don't understand why, go ask your Roman friend down the street, or ask your German friend who lived through the early German Weimar hyperinflation. But it's like, oh wait, I can't ask them? Yeah, that's right, because those economies totally collapsed, right? Where's Rome today? They're gone. Why are they gone? Well, because the government spent too much money and then they basically depreciated all their coins, which is effectively the same thing as money printing. You can't print money. It destroys nations, right? Yes, it's crazy. And that's why I've actually got that graphic. So just in case any of you were thinking that I'm not actually being legit about this, here's the 2018 United States federal budget. And you can see right in here where it says the actual revenue of the IRS was 3.3 trillion. And the expenditures, that's the bills, was 4.109 trillion. And so that made a $780 billion deficit. And you can easily just look up the national debt. I don't have to look that up for you. Everybody knows it's like 22 trillion. So yeah, I did use real numbers, right? I didn't fudge that at all. So now let's look at the problem that you're going to have with the last time the Fed printed up a bunch of money and gave it to the government. They did it through the program called quantitative easing, right? And quantitative easing was basically them just printing money out of nowhere and then going in and buying treasury bonds. Well, at the end, the Fed had all these treasury bonds, right? And it was a temporary plan where they were going to print money, buy treasury bonds, so the government actually had enough money to pay their bills. And then they were going to slowly sell them back into the market, right? Well, that's what you're looking at right here on this actual chart. And let's go to maybe 10 years. So here was the QE program. Here's QE1, QE2, QE3. Then QE3 basically ended somewhere right around here in 2014. And that's when actually I initially thought maybe the market was going to crash. But then they were going to do their quantitative tightening QT program, which basically means all this money we printed out of nowhere and gave it to the government, we're going to start selling those bonds back out to kind of basically, which is also weird because then the Fed is left with all this cash, and what do they do with that? I don't know. So anyways, so they were going to start reducing this balance sheet, right? And so you can see they started to reduce it, but then it kind of went up again, then it started barely going down, and clearly it's nowhere near down, right? It's still super high, and now here we are like basically at today, right? And so what you've effectively got is that they didn't really unwind. It wasn't temporary. All that money is still sitting there at the Federal Reserve. And then you run into the next problem, right? So that wasn't temporary. It wasn't really a good fix. Actually, let's go to this one next. So if you look at the bond market, I was just telling you guys, this next bubble might actually be a stocks, housing, and real estate, and a bond bubble actually popping, all three of them at the same time, right? And this is one of the reasons why. What you're looking at here is the U.S. Treasury rate. That's the U.S. Treasury bonds that were being basically sold by the Treasury to people. That's you loaning money to the government. Well, here's the big idea, and it's very simple. Just see how the percentage is going down constantly. That means over time, the U.S. government's been paying people less and less money to actually loan them money, right? You're getting almost no value. Well, when you get down here around zero, you hit a big problem. If they're not going to give you any money, why are you going to loan your money to them, right? If you have $10,000, why are you going to loan it to the U.S. Treasury to get like a 10-year bond that pays 0%? They've got your money for 10 years and you get nothing for it. So as the lower that goes, the less you want to do it, right? Which is one of the reasons why also they printed money. But this is a problem, right? So all these people that are savers that need to go into retirement, they can't because they're not making any money in their accounts, right? Inflation is still going. but they're not making any money by like buying bonds and things like that. And so you have this thing that's basically like the 40-year bond bubble that's getting ready to blow, right? At some point, people are just going to say like, hey, you know what? No, thank you. When bonds go all the way down to zero and you don't make any money, you're not going to give your money to the government. But if you don't give your money to the government, you still have this crazy problem from before where they don't have enough money from the IRS, so they have to sell bonds, and that means money printing. That's pretty much the only choice that they have left. That's what they're going to do. So those are the problems that are coming in. Now, let's go to the final point of the video so I can actually, I've set it up now. Now I can finally describe what just happened recently, right? And here we go. Now, what you're looking at here, the yield curve is not understood by a lot of people. Let me very quickly explain it. When you loan your money to the government to actually, like, so you can buy a bond, basically. Now, you can give them your money for different amounts of time. You can go, and you can see it here on the chart. There's a 3-month bond, a 2-year bond, 5-year, 7-year, 10-year, 20-year, and 30-year. Generally speaking, the longer you loan the government your money, the higher interest you expect to get, right? I mean, if I'm going to give my money to somebody so they can do something with it, if I give it to them for like a month, okay, fine, pay me 1%. But if you're going to have it for 10 years, okay, I expect maybe like 5%. You want more return when your money is tied up for longer, especially because of inflation, right? So what you should see on the yield curve is when you look here on the left, the shortest term loans, so like you buy a treasury bond that's only for 3 months, you get the lowest interest rate, and you come all the way here to the top where for 30 years now you're making like almost like 5% on the actual money you're loaning to the government. That's the way it should work, right? The longer you loan them money, the more money you're going to get. And so the yield curve is basically just the different years, how long you loan your money to the government to buy bonds, stacked up next to each other. And then you can see how that interest rate changes basically over time. Now what you've got here on the right side is you've basically got the stock market, right? And the reason why everybody cares is because you'll notice that yield curve, it actually goes up and down. It changes over time, right? Because there are moments in time where for some crazy reason, things like this happen, where even though you loan your money to the government for a longer amount of time, you don't really get any money, much more money for it. You get the same amount or less, right? Which is like, well, why would I give them my money for a short amount of time? I'll just keep doing the short-term loan, right? So that's called a yield curve inversion. That's when the longer time you loan your money to the government, you don't get as much, you get less, right? Now, the reason why everybody cares is because there's a specific way when that yield curve inverts, it has predicted every single market crash for the last like 40 years, right? Without fail. And it's with like one thing specifically. See right here, you got the 2-year, and then right here, you got the 10-year. When those two flip around, the 2-year should be lower rate than the 10-year. But if the 2-year ever gets above the 10, that's called a 2-10 inversion. And that's the big red flag. That's the big signal. And that's what just happened today. And that's what caused that market crash to come. And you can even see those inversions. Like, so first of all, this right here, this was .com. This was 2008 bubble. And here we are today, right? You look at that yield curve before, and it's getting up there, but it's not quite inverted yet. And then you hit a point where the yield curve, see if I can find it right there, inverts on the chart. And then we have a crash and it goes back to normal for a while. And then it gets back up, it inverts again, then boom, crash. And so for a long time, from 2008 all the way until recently, it was a normal yield curve. Notice also it's very low because you saw that other chart because they don't pay much money anymore. But then you start getting up to now where we are today, and bam, that's where we're at. And in fact, this isn't even updated yet. What we just did today is that 2-year got above the 10-year, so it's actually inverted, right? So now you've got the same signal that, again, be very clear, has predicted every single market crash for the last like 40 years just happened, right? Last piece I'll say about it is the reason why the reason why that happens is when people go piling into the bond market to buy bonds, the government doesn't really have to pay them very much interest because like everybody wants to buy them. It's just supply and demand, right? So if everyone's running in and being like, I want to buy the 10-year bond, I want the 30-year bond, and all these people are buying bonds, well, the government's like, well, I'm not going to pay you 5% when you'll buy it at 1%. So fine, here's a loan, 1%. And then people are like, oh yeah, and they take it. But then that short term is actually a little bit higher. And there's a more complicated thing there. One of the ways that the Fed suppresses rates is by buying the short-term bonds, which shoves them up. So, that's too complicated. I'm not going to get into that. Big point is that when you look at the bond market, it signals where things are actually going. And like I was telling you guys before, what's possibly going to happen, I think is going to happen, is that we're going to have another market crash. It's long overdue. It should have happened a while ago. But they keep printing money and dropping rates and doing all these crazy things. But I do think we're probably going to have one. It might have just started. And the 210 inversion, that might have been the signal for today. So I hope that made sense, guys. Thanks for tuning in. Share this video with your friends. And sorry for the bad news, but at least you know now so you can start to do something about it. So, and again, I'm not a financial advisor. I should clarify that. I'm just a dude. I'm just an engineer. This is my perspective on things. It's as correct as I can possibly make it. I'll put all the links for these websites below. Invest at your own risk. But this is what I'm looking at, guys. So have a great day. Bye.